Hello and welcome back to our Ellisons Connects podcast. I'm Nicola Weldon, partner and head of the private client team at Ellisons, and today we're unpacking the latest budget, what actually matters for you and your family. And I'm here with Ian Johnston, private client partner in our Chelmsford office, to make sense of it all. There's been a lot of headlines, a lot of noise, but we want to focus on the changes that really affect our private clients, people thinking about their estates, their homes, their businesses and long-term planning.
Exactly, Nick. And while the Chancellor said there were no tax rises, well, there's quite a lot in here that will mean higher tax bills without good planning, just through the back door.
Thanks, Ian. So let's start with the overall theme. So there were no headline changes to income tax rates, which has meant that the basic and higher and additional rates have stayed exactly the same. They were previously frozen until 2028, then 2030, and now all the way to 2031. So Ian, what does this mean for individuals?
Well, what it means for individuals is that even though the rates haven't gone up, more and more people will be dragged into higher rate tax bands over time, simply because earnings rise with inflation, but the thresholds don't. In our part of the world, we have property prices increasing as they are wont to do over the last, couple of decades or so. So we have the classic fiscal drag. People think, well, my salary only went up by a couple of percent, but it doesn't matter. If the threshold doesn't move, you can still end up paying more tax. And it's the same with national insurance thresholds. Again, as you mentioned, they've been frozen until 2031. So overall, it's more tax without actually saying it's more tax.
Okay. And I've also noticed that despite there being no increases to the headline income tax rates, there are some increases on investment income. Can you perhaps tell us a little bit more about that, Ian?
Of course. So from April 2026, the dividend tax is going up by 2% for basic and higher rates. And from April 2027, tax on savings income and property income rises 2% as well, meaning the top rate on those will be 47%. This will affect clients with investment portfolios, rental properties, family investment companies, anyone who receives dividends or interest from outside a tax wrapper like ISAs or pensions.
Do we know why they've chosen to make those increases, Ian, in the investment income?
The government seem to be suggesting that they look to tax people with unearned, as they call it, income. So the investment income isn't earned income in the way of a salary, it's income that's generated by an investment, be it property or a company, but the person isn't taking it by way of a salary.
Okay, so I suppose they're capturing that national insurance, I suppose, aren't they? Which you don't get on the investment income.
Exactly right.
Yeah. Okay, so it sounds probably then a good time for clients to review how their portfolios are structured then, and whether they're making the most of tax-efficient wrappers, perhaps.
Yes, exactly. We're looking to talk to a lot of clients at the moment with their financial advisors and their accountants to make sure there's a joined-up approach, but clearly the obvious one is making sure that people do maximise their ISAs to get that tax-efficient income, which is outside people's estates, for income tax and capital gains tax. Okay,
lots to be thinking about. And we're only just getting started. Okay, so like the income tax thresholds that we've already discussed, the current national insurance thresholds that you've just mentioned have also been frozen until 2031. So I assume this is still likely to increase overall tax taken because, again, the thresholds are not going to keep pace with inflation. There was also an unexpected change around salary sacrifice pension contributions. Can you maybe tell me a bit more about that?
Exactly, yes. No, this is one of the unexpected changes, which means that from April 2029, and again, that might seem a long way off for people, but there's the opportunity to plan now. It will be here sooner than we think. So from April 2029, only £2,000 of employee pension contributions through salary sacrifice will be exempt from national insurance. Anything above that will be subject to national insurance contributions like any other ordinary contribution. So, as I say, it won't bite immediately. We've got 3 years till we get to this tax coming in. But people who do rely heavily on salary sacrifice often are higher earners already, and they should start to plan now to make sure they've got all of their ducks in a row. And again, that feeds into the broader theme of the budget. It's making sure that people are having the conversations now to make sure that freezes and tweaks are taken advantage of or made sure that they're planned for in the future to avoid what this fiscal drag is bringing to people's estates.
Yeah, so there's lots of stuff sort of hidden in the small print, isn't there, in this budget? It seems to me anyway.
Exactly right. So there were no broken promises,
yeah.
but with fiscal drag taking its effect, there will be a lot more people who think this doesn't affect me, but actually it will affect you more than you might realise.
Yeah. Wonderful. Well, and another one on that one, I suppose, is the big announcement about the high value council tax surcharge. That starts in April 2028 and applies to homes over 2 million. I mean, it strikes me that there's probably quite a lot of properties, especially in and around London, that's going to affect a lot. I don't know, what are your thoughts about that?
Well, again, our property colleagues will have a better view on how that might affect the market, but you're exactly right. There are a lot of properties in London and East Anglia where we practice that will be caught by this. The surcharge starts at £2,500 a year for houses just over 2 million, and will rise up to £7,500 for homes worth £5 million or more, and it is going to increase with inflation. Importantly, it's paid by the owner, not the occupier. So if you did have a property that was rented out and it was over and above this amount, it's the owner, not the occupier, who pays that bill, which is quite different to something like council tax, whereby it's the occupier who would be expected to pay that. It's the owner at the land registry who's responsible for this surcharge.
I wonder if that will see an increase in rents. Maybe landlords will pass on that cost to their tenants, I suppose. We'll just have to wait and see, won't we?
Exactly. It's a while for it to come in, but again, it's about having the conversations now to plan for these sorts of things. But clients with second homes, large family homes, or people who've inherited properties suddenly might find themselves in this situation that they've never been in before, where not only are they having a house that might be paying additional council tax. A lot of councils nowadays for second homes are charging additional council tax, but this is an additional levy on top per year, which people really do need to be planning for and thinking the best strategy to make sure that their tax liability is minimised where they can.
Yeah, good advice, Ian. Thank you. Capital gains tax. So we've spoken about income tax, we've spoken about taxes on investments and property. I've noticed that the capital gains tax rates didn't change themselves, which is a relief. But I think there are two key reliefs that have been cut. And I just wondered if you could tell me a little bit more about them.
Of course. There were two particular changes, as you mentioned, and this is one that clients should be talking to their accountants and ourselves about. Our corporate team in particular have got a lot of expertise in dealing with the first point being employee ownership trust disposals, which is where people were able to exit their businesses and claim 100% relief on capital gains tax. They're quite popular, they were very efficient, and they enabled businesses to carry on succeeding, profitable businesses, for someone to exit whilst the business could carry on with people in the business being involved in running the business. The big headline rate that was unexpected was that this dropped from 100% relief to 50% relief for capital gains tax.
Wow, that's a big change.
Big change, and it's effective immediately.
Okay.
So that was unexpected. It does mean that people now may be slightly more reticent to think about an exit, but again, talking to your professional advisors and the experts means that there will be ways that we can talk about how other options might be available to you or how to deal with things in a more efficient way. Yeah,
I think that's the key, isn't it, through what we've been saying, is about getting sort of your ducks in order, getting the advice, getting your accountant, your financial advisors and your lawyers working together.
Exactly, and it's better to plan these things in advance rather than jump into something panicking that the government have done this or that and then come and have the conversation afterwards. It's much better to have the conversation in advance. We are still in the current tax year. Yes, the employee ownership trust capital gains tax came in immediately, but there are things that we can be doing to plan. It's far better to plan for the future than try and rectify things afterwards.
Yeah.
As well as the employee ownership trust, we've also got the business asset disposal relief and investors relief. And again, that increased. So that went from 14% to 18% from April 2026. So we're not quite there yet, but at the same time, that's coming in. And a 4% increase is going to be punchy for people.
Yeah.
Again, it's going to make people think about how best to maximise their availabilities and how best to structure their businesses moving forwards.
Thank you, Ian. I think in our the area of work that we are focused on, a lot of our advice we're giving is about estate planning, which obviously touches on income tax and capital gains tax, but in particular inheritance tax. And we've had lots of clients speaking to us over the last few months about agricultural property relief and business relief, because there have been lots of changes. I don't know about you, I had quite a few clients leading up to the budget, and we were undertaking transactions and work to try and make sure we could capture maximise the reliefs available that we thought they were going to be. But then there's been another change post the budget. So could you sort of tell us where we are now, where we thought we were going to be, and now actually where we think we're going to be?
Of course. The first thing to make everyone aware of, whether you think you have assets that qualify for business or agricultural relief, or if you don't, is that the nil rate band, the amount everyone gets to leave free of inheritance tax, and the residence nil rate band, which is the additional allowance if you jump through certain hoops, tick certain boxes, are both frozen till April 2031. So I know I sound like a broken record, but again, fiscal drag means that those rates have been well over a decade now set at that level with the nil rate band. Property prices, everyone knows, in the last decade have gone up considerably. So we're still at £325,000 subject to any gifts that you've made, which means a lot more people are going to be caught, even if they don't think they have what might be considered complicated estates or glamorous estates. You may still be caught by inheritance tax and therefore need to take advice about how you can structure things to make things pass as efficiently as possible.
Yeah, and 2031 seems quite a popular year for holding these reliefs.
Some would suggest that, in fact, we probably have another election between now and then, so we can only plan for what we've been told and make assumptions based on what we know at the moment, not what the magic crystal ball tells us in the future.
Yeah.
I think an example, Nick, of that, as you talked about, is the changes to the agricultural and business relief. It seems we've been dealing with this for well over a year, since the 2024 budget, the first one under the new government, where the Halloween budget, as it's known, and suddenly the allowances for business or agricultural assets were taken from being limitless to £1 million.
Yeah.
At the time the announcement came out, it wasn't transferable between spouses. It really was a kicker for people who are farmers, landowners, people who work the land, people who own their own businesses, have built those businesses up, suddenly thinking, hang on a minute, we're going to have a big capital gain, we're going to have a big inheritance tax bill here. How are we going to deal with that? Obviously, a lot of people have seen the uproar this caused, both in the business community and in the farming community. The budget brought that change, which was that the allowance was then going to be transferable between spouses, but that is subject to a few caveats. And then suddenly, out of nowhere, just before Christmas, the government announced, 2-3 days before Christmas, actually they were increasing that allowance from £1 million to £2.5 million per person, and that it is transferable. So in theory, a married couple with good planning could have up to £5 million that they could have in their estate, which qualifies for agricultural or business property relief.
Yeah, and I think this is where it makes it really difficult. And you said about the crystal ball, because all we can do is advise our clients based on the information that we have. And with the budget coming up, there was no indication that that was actually going to be increased. And then, it's brilliant that it has been. It's, I think it's much fairer for our clients. Whether or not it's gone far enough, that's another question and discussion for another day. But it's definitely a much preferable position.
I think the other big thing that we need to be making people aware of is that even if your assets that have business property relief or agricultural relief are over and above that allowance, your relief for inheritance tax purposes is that you get your estate pays half the inheritance tax. So you don't pay tax at 40%, you pay tax at 20% on any of those assets if your assets were over £5 million, and if you put the right planning in place to make sure that between a married couple you can claim that allowance.
Oh, that's a good point. So actually, in terms of planning and putting things, have we got deadlines we need to be thinking about?
April 2026 is the big deadline.
Yeah.
That's where we need to have made sure that everything is in place, if at all possible. At the time of recording, that gives us nigh on just under 3 months.
Yep. Plenty of time.
But it is important that people have these conversations. It might not be right for everyone. There may be people who, for whatever reason, don't want to transfer assets between spouses. There may be people, and Nick, you and I are fully aware that sometimes family diplomacy and politics means that actually if people feel, well, £5 million tax-free for what we've got actually is far better. It's not like it was 2 years ago, but it's far better than it was 18 months ago. So actually, we'd rather not rock the boat. You always need to be careful when it comes to rushing into making decisions and looking at the whole picture, which is where our advice with your accountants, with your land agents can come into play to make sure that we do both maximise the tax incentives, but not let the tax tail wag the dog.
No, and that's the thing, is we've focused on these the tax rises and changes and reliefs that are going to be frozen and how that will impact. But like you rightly say, you don't necessarily always want to be bending over backwards just to save tax, because there might be bigger issues out there.
Exactly.
Yeah. So in terms of what clients should be doing before the end of the tax year, what should they be thinking about?
It's a full review, I'm afraid to say, for everyone. That starts with reviewing actually what do you have. If you think you qualify for agricultural or business relief, or even if you're not sure if you do, have a look at everything. There's been a lot of diversification in the farming community over the last few years, which is brilliant and has brought streams of income to clients that would never have been possible before. But it's making sure that actually is there the paperwork to show exactly what's happened. If there has been disposals of land, have they been properly recorded, both at the land registry but also in any sort of partnership agreement, any capital accounts, to make sure that we've got a clear picture. It's really a good excuse for a proper clear out of where people are in their farming families.
Yeah. I suppose it's opportunities as well to look at shareholders' agreements. Do they need to be updated? Are wills reflecting what everybody thinks the shareholders' agreement says? Lasting powers of attorney, I suppose, as well. There, it's a good opportunity, like you say, just to have a real good review of everything. Exactly.
Like every good solicitor, we advise people that every 5 years or so, if not more regularly, they should review their wills. This is the real red flag moment of if you haven't reviewed them for 5 years or longer. And again, we appreciate we have clients who have wills that come out a little bit yellow and dusty out of the will cabinet when we need to see them because they're older. You need to be reviewing your wills. You need to say, right, are they still appropriate? There are some people who their wills, even when they were drafted being perfectly tax efficient, won't be efficient now. And it's really important that those people don't accidentally find themselves triggering an inheritance tax liability, perhaps on the first death that they previously, when they had the advice, was perfectly fine, but now has changed. And they could end up triggering an inheritance tax liability immediately, which could put the family or the business under strain to satisfy a bill that could have been postponed or mitigated.
I think that's true, isn't it? Private client, or there hadn't sort of, over the years gone by, there hadn't been that many changes really, but over the last few years there seems to have been quite a lot of changes to inheritance tax, to capital gains tax, to the reliefs that people might not necessarily know about unless you listen to things like this podcast, I suppose.
I think you're right. I think that, in all honesty, the last big change for inheritance tax was probably 2007 when we got the transferable nil rate band. So a lot of people have perhaps made the assumption, correctly or incorrectly, that with a double allowance, that means that everything will be tax-free, not a problem at all on the first death. But lots of people still have wills that contain trusts, trusts that might capture agricultural relief. But it's making sure that if you have a will that contains something like that, rather than resting on your laurels thinking that will do me fine, having it reviewed to make sure that actually you don't have too much in your name that goes into a trust, which does trigger an immediate tax liability upon your death. So that is the big takeaway from here, is reviewing your wills, making sure you have wills if you haven't, and also if you've brought future generations into the business. Again, a lot of people bring their children into the business, but those children might not have wills, and it's making sure if they're involved in the business, if they're shareholders in the business, that they've got appropriate things in place as well.
Yeah, I suppose that's the same as if you're passing on any assets, really, isn't it? Not just even necessarily business assets, but if you're doing some tax planning and making some lifetime gifts, perhaps passing things on to children, like you say, they need to make sure that they've got wills, or you might be looking at declarations of trusts to protect the assets and everything.
Exactly, and again, it goes back to the point of the importance of taking professional advice, is that what Bob down the pub tells you he's done and was perfect for his scenario may not be as perfect for yours, because with our expertise over the years, we can explain, well, have you thought about X or Y? Yes, your children are happily married at the moment and it all looks perfectly rosy, but we're here to say things don't always quite work out as they are. Our family department, this is a January podcast, our family department have had more calls than would normally happen after Christmas, I'm sure, at this time of year. And it's also, again, about protecting your assets, your hard-earned assets, against things that might happen that you don't think about or you may not be able to control, rather than just assuming everything is going to be perfectly happy forever.
Yeah. I think another thing that seems to have sort of snuck under the radar is a treatment of pensions. So I think that's going to have a really big effect. And like you say, some people might think, oh, my estate's within 325,000. I've got the residence nil rate band. Everything's going to be fine. But they might not realise that actually the pensions are now going to come into the pot. So what was the position with pensions and where are we at now? What's changed?
So in the past, the ability to pass your pension on to your family free of inheritance tax, doesn't matter the value of your pension, was a huge asset and a huge opportunity for people. However, in the first budget, the government did say that from April 2027, from April 2027, the value of your pensions will now form part of your assets for inheritance tax purposes. That has a couple of points that you need to be aware of. And again, if you are in a pension scheme where that qualifies, you may have never even thought that you needed to take legal or financial advice about your pension because it ticks along and there's not a problem whatsoever. But it's something that you need to be aware of, that now suddenly your estates could well be in the inheritance tax regime without you even knowing so. Some pensions have been very generous during people's working lifetime. And there's been a lot of encouragement to put towards your pension, the tax reliefs as you've made salary sacrifice or as you've put into your pension to get those reliefs, potentially could now come back and bite your estate after you've gone. But again, it's important to have the conversations rather than just rush to do something and then think, oh, actually, I wish that we'd sat and wait or taken advice, because you don't want to suddenly rush and say, right, I want to do this, I want to do that, and take everything out and then regret it. Again, it's about taking advice and saying, right, how can this work in the future? Financial advisors these days, a lot of the ones that we work with, and you may have your own financial advisor, have these situations. They have cash flow modelling, so they can say to you, right, well, this is how your sort of cash flow will work out in the future. If you do suddenly panic and take out a big lump sum to try and mitigate the inheritance tax, well, this is how it will impact you on the future. For some people, that might be a good idea. For others, it might not. It's why it's important to take advice to make sure that everything is all lined up before you jump.
And absolutely. So that brings us back to the point of working with your sort of trusted advisors together, isn't it? Because as lawyers, we're not allowed to give financial advice. So it's important to have that financial advice together with the legal advice if that's necessary as well.
Exactly. Unfortunately, it does mean for people that there may be some paperwork involved between now and certainly April 2026 and into the future. But the savings and the potential that we can sort out for people within that time is over and above the cost of having to deal with some paperwork.
Yeah, absolutely. I mean, so we've touched on a little bit about lifetime gifts, about giving things to children and things like that. I'd heard speculation before the budget, but that there might be some changes to the gift rules about how long you have to survive after the making them and the application of taper relief. Were there any changes?
No, there weren't in the end. So at the moment, just to remind people, every individual has the £3,000 limit that they can make a gift of in any financial year, and it's immediately outside of your estate. Now, I'm led to believe that £3,000 limit was set sometime in the 1990s and hasn't increased since then. So again, fiscal drag, £3,000 in the 1990s would have been a much more generous gift than £3,000 in the current tax year. There was the suggestion that there was going to be a cap on how much you could gift during your lifetime, but that again was just badly leaked news to the press and didn't come about. You can gift more than £3,000 during your lifetime. You can gift as much as you want, but Firstly, you have to make sure that you don't derive any benefit from whatever you gift. So you can't gift money to someone and say, actually, can I have it back in 5 years' time or anything like that? Once it's gone, it's gone. Again, to my earlier point, that means that you do have to be careful and take advice about, do you want to make absolute gifts to someone who might be in a vulnerable position when it comes to something like benefits that might impact on them, or in a matrimonial situation where they might not thank you for receiving a lump sum of money that suddenly they get divorced in a few months or years' time, and that counts as part of their estate.
Yeah.
But in theory, you can gift however much you want if you have the capacity to do so. And after 7 years, that gift will fall outside of your estate for inheritance tax purposes. Now, even if you weren't to survive 7 years, after 3 years you start to see a benefit, because the tax due on that gift starts to taper away after 3 years. And in effect, every year after that 3 years, the tax is reduced a little bit further until you get to 7 years when there's no tax payable whatsoever.
I think I'll just seize on that point actually about taper relief, because I think there's often a lot of misunderstanding. I think sometimes people think taper relief actually applies to value of the gift, but it's not the value of the gift, it's actually the value, the tax payable on...
Exactly right, yeah. And the simplest way I always say it is that it's 20% of the tax each year that tapers away from 3 years through to 7 years.
Yeah.
To that point, Nick, perhaps you'd like to sort of give us some input on, we had previously a lot of clients who considered, if they were of an age where they were concerned about surviving 7 years or even 3 years, they looked to invest in business property relief schemes, even if they weren't business owners.
Yes.
And that was an attraction that a lot of people took advantage of. Perhaps you can sort of speak more to that and tell us how that's changed.
So that's links in really with what we spoke about business relief, doesn't it? So it's where people, like you say, would invest in portfolios perhaps offered by financial organisations, and those investments would qualify for business relief, meaning that after the shares have been held for a certain amount of time, you could get 100% relief on those investments, so there'd be no inheritance tax to pay on them. So there are specific types of investments, and as I say, there's conditions that apply for that relief to operate, but that relief has actually now been cut to 50% from the full 100%. So that means rather than being no inheritance tax to pay on those investments, it's now 20% rather than 40%. So those investments still attractive perhaps for individuals. People would have to take financial advice, but not necessarily as attractive as they were before. And those investments are outside the £2.5 million cap we've spoken about previously about business relief. Yeah, I've forgotten about that one, Ian, so that's a good one to mention. Thank you.
You're very welcome.
So I think, so we're coming to an end really, aren't we, of what we've spoken about and the changes in the budget, and from a private client perspective, how they would impact people, and what people perhaps need to be thinking about doing now.
Exactly right. As I say, my takeaway point to people listening to this would be, no matter how straightforward or for that matter how complex you think your estates are, review whatever it is you have in place, be it your will, be it, as you mentioned earlier, your power of attorney, be it your partnership agreement, your company documents, whatever you might have, your property ownership. Make sure that everything is in place. There are a lot of allowances available, but the government don't automatically give them to you. You need to make sure that you've got the paperwork in place so that when you're no longer here, your family, your advisors have everything lined up to be able to immediately say, here's everything, which is why we can claim these reliefs, rather than trying to recreate it after the event when you're no longer here to explain something that you knew all about, but no one else got that information.
Yeah. And I think we've sort of focused on the end of this tax year as a sort of an action point, but I think even if people were listening to this podcast after then and think, I've missed the date, it's still very much worth reviewing your affairs. I think that you'd agree with that.
Oh, very much so. As we've talked about, a lot of these changes, whilst there are some that are happening April 2026, we've talked about some that go as far as 2031. It really is important that whenever you hear this podcast, you do think, actually, for the sake of a hour conversation, you get peace of mind, and it could make significant inheritance tax savings by having a conversation that you might not have thought you even needed to have.
Thank you for that, Ian. I think, we've got a big team here at Ellisons in our corporate commercial team, our property team and our private client team, family team we've mentioned, so there's plenty of people here that can help anybody who's listened to this podcast and might have a question. So I would invite anybody that if many of the changes we've discussed today raise any questions for you, whether about your estate, your pension or your business, or how best to structure your investments, we're always here to help at Ellisons, or perhaps we can refer you to a financial advisor or an accountant if you don't have those in place yourself, and if that would help. Unless you've got anything else to add, Ian?
No, I think that we have hopefully given you a flavour of the opportunities available to people and the importance of reviewing documents with the changes in the government legislation as it's come in. None of us do have that crystal ball. No. We don't know what the future has in store, but we have certainty at the moment, at least, as to where we are to make sure that everything we can do with your advisors as a team to put things in place works for you moving forwards.
Brilliant. Well, thanks ever so much for joining me this morning.
Thank you very much.
And thank you for our listeners, and we'll see you again here on the next episode of Ellisons Connects.
Any additional guides and insights we've mentioned today will be available on our website. We hope you found this episode insightful. If you would like to discuss anything further on this subject, then please do get in touch via our website, www.ellisonsolicitors.com. Please don't forget to subscribe to our podcast and follow us on our social channels to keep up to date with the latest news and insights. Any information shared on this podcast was accurate at the time of recording. However, we advise speaking to your usual Ellisons advisor to make sure there hadn't been any changes since. Thank you very much to Punch Studios for producing this podcast series.